Cyprus, March 2013. A woman stands at an ATM in Nicosia at 6 in the morning. She's been there since 4. The screen says her daily withdrawal limit is now €60. Yesterday, it was unlimited. Her savings account held €43,000 on Thursday night. By Saturday morning, the government announced that accounts above €100,000 would lose 47%. Hers was below that threshold. She thought she was safe. Then the percentage changed. Then the threshold changed. By Tuesday, she couldn't access her account at all. The bank's website showed her balance, but the money had become a number without meaning. She had followed every rule. She had saved in the local currency, in an insured institution, in her own name. The system didn't collapse. It froze, and freezing in the middle of a crisis is functionally identical to collapse. That moment keeps repeating. Argentina, 2001, Greece, 2015, Lebanon, 2019. The pattern is always the same. The system doesn't explode. It simply stops processing your claim to wealth. This video isn't about predicting the next crisis. It's about understanding what moves through crises when everything else stops moving. What gets out when the gates close. What holds value when value itself becomes a political decision. And why the answer isn't gold. There's a framework that explains every major currency crisis of the last century. It has 3 stages. Each stage determines what survives and what freezes. Stage 1 is the recognition lag. The system is already insolvent, but the institutions haven't acknowledged it yet. Money still moves normally. ATMs work. Prices haven't adjusted. People still believe their account balances represent real purchasing power. Stage 2 is the control phase. Institutions acknowledge the problem by restricting access. Capital controls appear. Withdrawal limits drop. Wire transfers require approval. Currency exchange gets rationed. The money is still there, in theory. But theory and access are no longer the same thing. Stage 3 is the repricing phase. The official exchange rate diverges from the real one. What you can buy with your frozen deposits becomes a fraction of what you could buy with physical currency. And physical currency becomes a fraction of what you could buy with assets that have no counterparty. Gold is the traditional answer to this framework. It's been the default crisis hedge for thousands of years. But gold has a problem that most people don't encounter until it's too late. Gold works perfectly in theory. It's no one's liability. It can't be printed. It can't be debased digitally. It exists outside the banking system entirely. But in practice, gold has a fatal flaw during the exact moments it's supposed to protect you. It's extremely difficult to use. Weimar Germany, 1923. Hyperinflation is destroying the Reichsmark. A man owns 10 gold coins. He needs to buy food. The bakery doesn't accept gold. The farmer doesn't accept gold. He has to find a currency exchange dealer, convert the gold into rapidly devaluing paper marks, then immediately spend those marks before they lose more value. The exchange dealer charges a spread. The dealer also reports the transaction. If he's caught holding undeclared gold, the penalty is confiscation. His gold preserved his wealth in theory. But accessing that wealth required intermediaries, and intermediaries are the first thing that stops working when systems fail. Zimbabwe, 2008, the Zimbabwe dollar is collapsing. People who owned gold were protected from currency destruction, but they couldn't buy bread with gold. They had to convert it into US dollars on the black market, exposing themselves to theft, fraud, and arrest. The gold held value, but the conversion process was dangerous, expensive, and often impossible outside major cities. People in rural areas had gold, but no access to liquidity. The core problem with gold isn't economic, it's operational. Gold doesn't circulate, it sits. And when you need to convert it into something usable, you re-enter the exact system you were trying to escape. This channel exists to study one thing: financial forensics. Taking past system failures apart to see what actually moved, what actually froze, and what actually kept people liquid when liquidity disappeared. Not theory, behavior. So what does move when systems freeze? The answer is surprisingly consistent across every modern crisis. Physical cash in a stable foreign currency, US dollars, Swiss francs, euros in some contexts. Not your local currency. Not digital balances. Physical paper in a currency that isn't collapsing. Argentina, December 2001, the corralito begins. Banks freeze all deposits. You can't withdraw money. You can't wire it. You can't access it electronically. But people who held physical US dollars could still transact. They could still pay rent. They could still buy food. They could still leave the country. Their wealth wasn't trapped behind a government decision. The difference is structural. A dollar bill is a bearer instrument. Possession is ownership. There's no intermediary. There's no bank that has to approve your access. There's no system that has to be online. You hold it, you spend it. That's the entire mechanism. Gold requires conversion. Digital money requires system access. Physical foreign currency requires neither. It circulates, it's recognized, it's divisible. You don't need to shave off a piece of a gold coin to buy eggs. And critically, it's accepted, not by everyone, but by enough people in enough places that it remains liquid even when local systems have frozen. Greece, 2015. Capital controls are imposed. ATM withdrawals are limited to 60 euros per day. You can't wire money abroad. But people holding physical euros could still operate. They could still pay for things. Their money wasn't trapped in the banking system. The people holding only bank deposits faced a different reality. They watched their account balances become inaccessible. They couldn't pay rent. They couldn't make large purchases. Their wealth existed, but only as data. Lebanon, 2019 to 2022, banks impose informal capital controls. Your account says you have $10,000. The bank says you can withdraw $500 per month, but only in Lebanese pounds. At the official exchange rate, the real exchange rate is 6 times worse. Your $10,000 is now worth $1,600 in purchasing power, and you can only access it in small increments. People who held physical US dollars faced no such restriction. This creates a strange paradox. The safest place for your money during a systemic crisis is often the least sophisticated. Not in a bank account, not in a brokerage, not even in gold, which requires conversion infrastructure. In a safe, in physical bills. In the asset that requires the least trust in institutions. But physical cash has limitations. It can be stolen. It can burn. It earns no return. Inflation erodes it in stable times. And holding large amounts of cash can trigger legal scrutiny, especially when moving across borders. There's also a liquidity ceiling. Physical cash works for personal survival and medium-term flexibility. It works for paying rent, buying food, and maintaining operations during a freeze. But it doesn't scale to large wealth preservation. You can't hold $1 million in cash safely for years. You can't diversify it. You can't move it easily across borders in large quantities. Physical cash solves the access problem. It doesn't solve the storage problem. So the real answer isn't one asset. It's a spectrum. For immediate liquidity and crisis access, physical cash in a stable foreign currency is unmatched. For long-term wealth preservation, gold still plays a role, but only if you accept that you're trading liquidity for security. And for both, the critical insight is the same. What survives a crisis isn't what has the best long-term return. It's what you can actually access and use when the systems that facilitate everything else stop working. Right now, in 2026, we're watching the conditions that precede Stage 1. Sovereign debt levels across developed economies are at peacetime records. Pension systems are structurally underfunded. Banking sector exposure to government bonds has never been higher. When interest rates rose rapidly in 2022 and 2023, regional banks in the United States began failing. Not from bad loans, from holding too many government bonds that had lost value. The response wasn't to let the system reprice. It was to create new lending facilities that allowed banks to value those bonds at par. The insolvency was papered over. The recognition was delayed. That's Stage 1. The structural damage exists. The institutions haven't acknowledged it yet. Europe faces a similar structure. Banks hold enormous quantities of sovereign debt from countries whose fiscal position has deteriorated. If that debt reprices downward, the banking system becomes insolvent. If the banking system becomes insolvent, deposits become inaccessible. Not gone, inaccessible, frozen. This isn't a prediction. It's a description of fragility. Systems don't fail because of single events. They fail because the structure becomes so rigid that any shock can trigger the transition from Stage 1 to Stage 2. And Stage 2 is always the same. Controls, limits, restrictions. Your money becomes conditional. So the question isn't whether to prepare, it's what preparation actually means. It doesn't mean panic. It doesn't mean abandoning the financial system entirely. It means understanding that the system is designed to prioritize its own survival over your access and acting accordingly. Physical foreign currency isn't a speculation. It's not a bet that the dollar will go up or down. It's a hedge against the possibility that your local system will stop processing your claims to wealth. It's optionality, the option to transact when transaction systems freeze, the option to leave when capital controls prevent electronic transfers, the option to remain liquid when liquidity itself becomes rationed. Gold serves a different function. It's wealth storage for scenarios where both your local currency and the global reserve currency lose credibility. But it's not a liquidity solution. It's a generational preservation tool. If you hold gold, you need to accept that accessing its value during a crisis will be difficult, expensive, and potentially dangerous. You're not holding it to spend, you're holding it to survive a currency reset. The practical synthesis is this: allocate based on time horizon and liquidity need. For immediate access and crisis flexibility, hold physical cash in a stable foreign currency, enough to cover 6 to 12 months of expenses. For long-term preservation across a currency collapse, hold gold. But only if you understand that you're sacrificing liquidity for permanence. And for everything else, remain diversified within the system, understanding that system access is a privilege that can be revoked. No one knows when stage 2 begins. No one ever does. The woman at the ATM in Cyprus didn't know on Thursday night that by Saturday morning the rules would change. She thought her savings were safe because they were in a bank. But the bank was safe only as long as the system allowed it to be. And when the system stopped allowing it, her wealth didn't disappear. It just stopped being hers to access. That's the difference. Gold preserves value but traps liquidity. Digital money offers convenience but requires system permission. Physical foreign currency offers neither the best return nor the best security. But it offers something more important during a crisis. It offers movement, and when systems freeze, movement is survival.